Oliver, I smell fear, and when I smell fear, I think about buying shares in Tesco, which today warned on profit and cut its interim dividend 75%. That's scary, but this is still a business which produces about £3 billion in cash flow a year. So even if that dividend is cut further and there's not much left, there still seems to be headroom, and in particular headroom for capital spending, which is about £2.5 billion for Tesco to fight back in what's become quite a nasty UK supermarket war. Tell me why I'm wrong.
I think you need to think about why there's fear in the air and think about what's happening at Tesco. This profit warning today was its second in 6 weeks, so clearly things are deteriorating at quite a rate. And what we know is that trading profit, this is a measure of operating profit, which was £3.3 billion in the last financial year, is going to be as low as £2.4 billion this year, and that's if things don't get worse for the rest of the financial year, which ends in February. So you'd be buying into a very difficult environment. There's a lot of competition, a lot of price competition. You need to think about where things could go from now for Tesco. They've got a new chief executive who starts work on Monday. Let's say he decides to cut prices. That's going to eat into the operating margin. That was about 5% last year. It could take it down, it'll be below 4%, even towards 3%. And if that happens, well, the shares, if you make some assumptions about where earnings will be in 2 or 3 years' time, the shares are still on about 15 times those earnings. So they're not particularly cheap, and there's still a lot of fear around. So I'd be very wary.
All right. I mean, one problem is that Tesco is too big in terms of its stores and the range within its stores. But even if margins do fall to 3% and Tesco decides to press on with cutting prices, it can still survive that though, can't it? And its competitors perhaps can't, because Tesco is big in the end.
It is big. It's got a very solid balance sheet, even though it's cut back its dividend. It is one of the strongest supermarkets. But I think troubled companies can stick around for an awful long time, getting even more troubled, and in the meantime doing a lot of damage to shareholder returns at Tesco. Tesco has a big store estate. It's not very nimble, whereas some of its competitors are, particularly the discount end of things, Lidl and Aldi, who are taking so much market share in this country. It's very hard for Tesco to sort of shift around, so it's got to move slowly, and yes, eventually some of those weaker competitors might fall out the way, but that might take quite a while.
Okay, and there's a last question here. We've been dancing around it. This big store estate, if you operate an aircraft hangar with a restaurant and a dry cleaner attached, it can be quite difficult to decide what to do with it when that model no longer works. But surely perhaps they can think about reducing their store footprint. I mean, is that possible? Is that their philosophy?
It's not their philosophy at the moment, and last year they were opening more big extra stores, as it calls them, but it could and perhaps should shrink them down or even close them entirely. One of the reasons Lidl and Aldi do so well is because they have much smaller ranges. Now, it's not easy to chop a warehouse in half, but the house builders are always looking for land. Why couldn't you just turn an extra store into a much smaller store and give some land to the house builders or sell it to them? That perhaps is a way out for Tesco, but that's for the new chief executive to decide, and I guess we'll wait until October when he has his first results statement to hear what he has to say about that.
Okay, in the meantime, be afraid, it looks like. Thank you, Oliver.